Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another Lessons in Valuation subscriber request 2-minute drill video. In these videos, I just go over a very high level introducing the stocks that were requested by subscribers and to just show you what the company looks like from a valuation perspective. So today I'm going to look at Nike. It was one of the highly requested stocks that I was asked to look at. And what I have on the fast graph here is just a plotting of the company's earnings per share going back to, and by the way, the company has a May fiscal year going back to 2005. And I want you to notice they had very consistent earnings growth during the first 12 or 15 years here. So if I look at it from the perspective of 2005, 2017, I want you to notice they had an earnings growth rate of double digit of 14.36%. Very, very consistent growth year after year after year. This is the recession of 08 and 09. Now, something I do want to say is striking about Nike and that I really like. Now, it's a AA- rated company with only 40% debt. It does offer a 2.37% dividend yield, but it does have a very low earnings yield, and I'll get into that in a moment. So looking at Nike from this perspective, it was an excellent company. Now, as I go forward beyond that, you see that they start running into some trouble operational-wise. If you look at Nike for like the last decade or so, earnings growth has averaged less than 2% a year. That's not very good. But I also want you to notice, even if I go out to max here and look at this thing from the full time period, note that the dividend, this is the white line on the graph, has increased year after year after year after year. That's a salient point about Nike, even when they were having these, what I'll call quasi-cyclical bouts of earnings issues here. Now with fast graphs, you can look at a company with earnings, you can look at it with cash flow, you can look at it with EBITDA, and you can look at it with sales. So let's look at sales real quick. Sales have begun to flatten as well. If I run this as a short-term graph, you can see that Nike sales have actually been faltering here recently, and that's important. So now when I bring in the all-important, and by the way, this is free cash flow. One reason their dividend is so good, they generally cover their dividend with free cash flow except for COVID. And if I look at operating cash flow, they also have very strongly covered their dividend. Now, going back to operating earnings, which I basically use when I'm evaluating the value of a stock. Remember, the most important principle of investing is to buy low and sell high, or hopefully be able to sell higher later. So when I put weekly closing stock prices, you can see how this is a 15 PE ratio, this orange line. You can see how Nike traded within range of that 15 PE. But then if I add the normal PE, the market started valuing Nike at a much higher valuation. So if I shorten the time frame, there was this period of time here where Nike was trading at almost 30 times earnings, 29 times earnings. But because it got so highly valued and because earnings have weakened so much, you can see that the stock price has fallen. Now, looking forward, I don't see Nike as being real exciting until they get through some of these issues they have here. From a normal multiple, they look a little better. But again, why would a company that's only growing at these numbers be trading at those high multiples? I'm more comfortable looking at it from a 15 multiple. Anyway, that's a high-level look at Nike. It's obviously a high-quality company. It's got a decent amount of debt, but they have been struggling with some earnings. And if there's no substitute for comprehensive research and due diligence. Hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to our channel, and take a look at subscribing to FastGraphs. It really can help you get a much better perspective of stocks in the stock market. Thanks.